Hey guys, it's Josh from MEXC. Welcome back to the channel. Today let's stay on the topic of liquidity, which is a fundamental part of both the cryptocurrency and financial markets. In cryptocurrency market, liquidity essentially refers to how quickly and easily you can swap your tokens for other tokens while avoiding drastic price swings. If an exchange is illiquid or has low liquidity, you could face slippage and a higher risk of liquidation. If you missed the previous videos on liquidity and need a more basic intro, you can find links to those videos in the description below. Alright, in today's video, we're going to take a deeper look into liquidity analysis, so that you can know how to tell whether or not a market is liquid. But before we start, there's a discount going on. Scan the QR code on the screen or find the link in the description of the video to sign up on MEXC and get 20% off all your trades. Alright, let's jump in. So what factors impact the liquidity of cryptocurrencies? There are three important indicators to take a look at: trading volume, market depth, and the bid-ask spread. The trading volume is the detailed number of a specific cryptocurrency that has been bought and sold on any specific market during a certain time period, usually 24 hours. So how is this a good indicator of liquidity? The trading volume shows us how much interest there is behind a move, which can provide a good indication of how liquid the cryptocurrency market is. So, do you want to see how to check this indicator on MEXC? You can access 24-hour trading at the top of your trading interface. Let's take Bitcoin as an example. In this area, you can check how many Bitcoins have been bought in BTC/USDT in a day. Next, we have market depth, which shows currently how many underlying assets are waiting to be bought and sold on the order book. It usually puts buy orders on one side, sell orders on the other side, and displays them cumulatively on the chart. Greater supply and demand can result in deeper market depth and a smaller bid-ask spread. Let's take an example from the buyer's perspective. If there were only one buyer and one seller on a market, then the buyer would either just have to accept whatever price the seller is willing to sell at, or decide not to buy at all. This is an example of no depth. Now, if there were 10 buyers and 10 sellers on a market, then the market depth is still not great. So the bid and ask price gap is high, and some buyers are going to end up having to pay more than they expected. Now, imagine if there were thousands or more buyers and sellers in a single market. This means that the market depth is deep enough, and the buyers' transactions can be quickly and easily executed at their expected price. Let's look at how to read a market depth chart. When there's a higher volume of red on the chart, that means that the selling pressure is high, and the market's underlying asset might be about to enter a correction phase. On the other hand, a higher volume of green indicates more buy orders, which gives the price more opportunity to grow. Now, why is this an important indicator of liquidity? Better market depth does equal better liquidity, and the depth chart gives us a view of how much liquidity the order book can absorb. The deeper the market is, the more liquidity there is in the order book. This reflects an exchange's ability to take on large orders without affecting the price. However, if the market is illiquid or has low liquidity, then such large orders may have a significant impact on the asset's price. Now, this also affects trading, because the better market depth an exchange has, the lower the trading cost is for traders. When you're placing a market buy order, it will fill at the lowest possible ask price. Conversely, when you're placing a market sell order, it will fill at the highest available bid. For example, there are two exchanges, A and B, on the crypto market. Trader Sam plans to buy 2,000 ETH USD contracts on the platforms A and B. The best ask prices on both exchanges are 1,000. However, they have different market depths. Exchange A has low liquidity. So in order to fill the 2,000 contracts, the system breaks Sam's order. So Sam would need to purchase his 2,000 contracts at $1,010 and $1,016 respectively. In short, Sam would be spending $2,000 to purchase 1.974 ETH in total. Which means that when Sam's order is actually filled, the best ask price has been pushed up to $1,013.70. Now, Exchange B has good liquidity, so there's enough liquidity on the market, and Sam's order can be easily fulfilled at his price. In other words, Sam would be spending his $2,000 to purchase 2 ETH in total. Meanwhile, even when Sam's order is filled, the best ask price remains at $1,000, because his order did not impact the price. So as you can see from this example, with the better market depth on exchange B, Sam gets more ETH purchased for the same amount of USD. Do you want to know how to check the market depth on MEXC? You can access market depth at the top right of your trading interface. Now let's look at the next indicator, the bid-ask spread. This is the difference between the lowest ask and the highest bid. We can simply think of it as the gap between the highest selling price and the lowest buying price. Why is this an important indicator of liquidity? The bid-ask spread is a way to measure the market's liquidity. The smaller the bid-ask spread is, the more liquid the market is. The bid-ask spread can also be considered a measure of supply and demand for a given asset. In this sense, the supply is represented by the ask side, while the demand is represented by the bid side. So how can you check the bid-ask price? The answer is an order book. An order book is a ledger showing the total number of limit orders. The order depth here shows in real time the number of buyers and sellers with orders awaiting execution in the order book. The prices in red are the selling prices, and the prices in green are the buying prices. In this illustration, the current best ask price is sell at $18,672.90, while the best bid price is bid at $18,673. So why does this relate to liquidity? The smaller the bid-ask spread, the stronger the liquidity of an exchange. A deep market can take large orders at a stable price. Greater order depth also helps to avoid price manipulation. Okay, that's it for today's video. I hope that you found it helpful and easy to follow, and you learned a little bit more about evaluating liquidity. If you did enjoy this video, please remember to give it a like. And if you want to keep up with the videos that we post in the future, please subscribe to the channel. Not to mention, if you have anything to say it in the comments below. We'd love to hear from you. And before I go, I want to remind you one more time of the discount going on. You can scan the QR code on the screen or find the link in the description of this video to sign up on MEXC and get 20% off all of your trades. Thanks for watching. See you again next time.